Are you paying too much for your debt? The answer is probably yes, but what if I told you there's an 83% chance you can fix it today? Stay with us. Welcome to Wealth Explainers, the podcast that gives you quick win strategies for mastering your money. I'm your host, and today we are tackling the single most overlooked financial trick that costs consumers billions: negotiating your interest rate. Here's the secret the banks hope you never find out. A June 2025 survey found that 83% of cardholders who asked their lender to lower their annual percentage rate, that's your APR, were successful. That's incredible. But here's the kicker. Only 25% of cardholders bothered to ask at all. That means 3 out of every 4 people are leaving money on the table because they haven't made a 15-minute phone call. Today, we're changing that. We're giving you the exact script and strategy to get your success rate above 83%. First, let's talk about why this matters. When you hear APR, or annual percentage rate, think of it simply as the true annual cost of borrowing money, including fees. High APRs are toxic to your personal finances because of compounding interest. On the bright side, compounding is fantastic for saving. It means you earn interest on your interest, like a snowball rolling downhill and getting bigger. But on the debt side, compounding turns into a financial trap, or a reverse snowball, where the interest you pay starts charging you interest, making small purchases grow into something that seems impossible to pay off. Many people are resigned to paying years of high interest, but even a small reduction can buy you back months or even years of financial freedom. Imagine you owe $10,000 at 25% interest. That costs you $2,500 in interest over the course of the year. If you negotiate that down to 15%, you save $1,000 that year, immediately available to pay down your principal balance. The analysis confirms that too many consumers, about 1/3 in fact, exhibit a certain financial inertia, whether it's getting only one mortgage quote or simply accepting the first credit card rate they're offered. They're satisfied with the status quo, even if a better deal is readily available. You must overcome that inertia. And remember, this isn't a confrontation. It's a simple comparison shopping exercise that saves you real money. Consider a debt of $5,000, which is a common balance. If you start at a 25% APR, which is typical for some store cards, and you successfully negotiate an average reduction of 6 percentage points, bringing you down to 19%, over just 3 years, that reduction puts nearly $600 back in your pocket. If you're dealing with a higher than average rate, like 27.7%, and bring it down substantially, the savings only accelerate your payoff time further. That $600 saved is money you can immediately put toward the principal, dramatically shortening your debt timeline. The negotiation is won before you even pick up the phone. You need 3 pieces of ammunition to maximize your leverage. 1. Know your financial health. Lenders scrutinize your risk profile, which is largely defined by your credit score. The higher your score, the better the terms you are likely to receive. If your score has gone up recently, make sure you mention it. Furthermore, understand your credit utilization ratio. That's simply how much debt you're using compared to your total available credit. If you're using more than 30% of your total credit, lenders see you as riskier. If your utilization is high, your best move before calling is to pay down a large chunk of debt first. This shows you are managing your existing obligations well and deserve a better rate. Leverage your loyalty. Before calling, note down how long you've held the card, and critically, point out your stellar track record of on-time payments. This gives the representative an internal justification for rewarding you as a loyal, reliable customer. Gather competitive offers. This is your biggest piece of leverage. Find a few competitive offers in the mail or online, especially balance transfer offers that have lower APRs than your current card. This transforms your request from a plea into a business decision for the bank. Lower the rate or lose a profitable customer. Now for the playbook. The process should only take 15 to 20 minutes. Step 1. Make the call and find the right person. Call the number on the back of the credit card that carries your highest interest rate. When you connect with the initial customer service representative, politely ask to be transferred to the retention, customer loyalty, or account services department. These people are empowered to make deals. Step 2. Start with loyalty. Write down the name of the person you speak to and the time you called. Then use this script. I've been a loyal customer for X years with a perfect payment history. I'm calling today to see what rate reduction you can offer me as a reward for my reliability and continued business. Step 3. Apply the competitive pressure. If they say no, pull out your second piece of ammunition, the competitive offers. I love using your card, but I've recently been offered a competitive rate elsewhere. I would much rather keep my business here. Can you match or beat that rate to retain my account? Step 4. Escalate for the win. If the representative still claims they cannot lower your rate, which is a common initial pushback, do not hang up. You have 2 final pivots. First, politely ask to speak to a supervisor. Supervisors typically have a greater ability to approve permanent reductions. Second, if a permanent reduction is impossible, ask for a temporary rate break, maybe a reduction of 1 to 3 percentage points for 6 to 12 months. Even a temporary break gives you crucial breathing room to accelerate your payoff plan. This proactive approach works. Consumers like Linda, who was considering bankruptcy due to overwhelming credit card debt, found success by negotiating with her creditors and consolidating her debt into one loan with a much lower rate. Or Michelle, who successfully pushed back against arbitrary rate hikes by simply asking logical, pointed questions until her creditor reversed their fees and rate increase. This small amount of effort, 15 minutes on the phone, translates directly into substantial financial benefits, freeing you from the debt trap years earlier than you expected. Don't just listen to this, do it. That phone number is on the back of your card. Grab your competitive offers and your notes, make the call, and start keeping hundreds, maybe thousands of dollars in your pocket this year. Your wealth starts with one quick call. Thanks for listening to today's episode on how to negotiate interest rates. For more smart financial management tips and quick win advice, head over to wealthexplainers.com. I'll see you next time.